Hi, I'm Philip Smith, financial planner with Tidepool Wealth Strategies, helping self-employed professionals and solopreneurs just like you cultivate resilience in your plans to retire well. This is the Financial Planning Podcast about money management, best practices for long-term growth, wealth building truths and fallacies, successful retirement strategies, and more, where I'll be sharing concise, actionable retirement planning guidance. Welcome to the Financial Flow. Welcome to episode 5 of the Financial Flow. I'm Philip, and today we're wading into the depths of our financial tide pool to take a closer look at the Solo 401k plan, an excellent retirement tool for the self-employed. Last week, I used a client who we'll continue to call Joe as an example. Joe's an insurance agent who had recently broken out and become self-employed, and he's trying to figure out what the best retirement plan option would be for him. He no longer had the safety net of an employer or their 401k plan, and he was in his late 50s with about a decade left to get to his target retirement savings. After discussing his options, the Solo K was the best fit for his needs. Flexible contributions with high contribution limits, the ability to save in a Roth account despite his high earnings, and an escape valve if necessary, the ability to include a loan provision in his plan. Now, in case you missed the last episode, let's do a quick recap on what the Solo 401k is. A solo 401k, also known as an individual 401k, what I'll continue to refer to as a Solo K, is a retirement plan designed for self-employed people with no employees, other than the possible exception of including a spouse. It allows for both employer and employee contributions, offering a great opportunity to maximize retirement savings. The Solo K works similarly to a traditional 401k, but it is tailored for self-employed individuals. As both the employer and employee, you can make contributions in two ways. As an employee in 2024, you can contribute up to $23,000, plus an additional $7,500 if, like Joe, you're 50 or older. And again, you have the ability to choose pre-tax, Roth, or a combination of both for your contributions. As the employer, you can also contribute up to 25% of your net self-employment income with a combined maximum limit of $69,000 or $76,500, again, if you're over age 50. This dual contribution capability allows for higher savings compared to other retirement plans and also helps you as the business owner shelter more dollars with increased tax efficiency. Joe didn't think he'd be able to hit the combined max limit, but he knew he could contribute enough to exceed the employee contribution limit, and from year to year, he occasionally adjusted his Roth and pre-tax contributions in accordance with his CPA's recommendations. The greater the business deductions in a given year, the more he would try to leverage Roth contributions. But in years where his deductions were lighter, he'd lean into the pre-tax contributions to reduce his annual tax burden. Now, I touched on this in the previous episode, but let's expand on some of the pros and cons of this type of retirement plan. You have access to high contribution limits. The combined contribution limits allow for substantial retirement savings. Think about it. In just 10 years, someone who is maximizing contributions over the age of 50 could save more than $750,000, save it, and reap some tax deductions as well. Yes, there are tax advantages. Pre-tax employee contributions reduce your taxable income, and investment growth is tax-deferred. Employer contributions get you business deductions and count as pre-tax dollars also. And of course, you have Roth, the ability to forego tax deductions today in order to have tax-free money in the future. Pretty awesome deal. With the Solo K, you have the ability to enable a loan provision, meaning you can borrow from your Solo K up to $50,000 or 50% of the account value, whichever is less. Remember though, it's a loan. You either pay it back in line with the repayment structure, or you default and it gets recharacterized as a distribution, which comes with taxes and a potential early withdrawal penalty on the original amount. Another beneficial aspect is investment flexibility. You have a wide range of investment options from stocks and bonds, ETFs and mutual funds to real estate and more speculative investment vehicles. Lots of good things to consider, but weigh it against some of these drawbacks. There are administrative responsibilities that come with setting up and maintaining the Solo K. There's quite a bit more paperwork and administration than one of the IRA plan options that I discussed in episode 4. The Solo K is the only plan available to the self-employed that comes with ongoing maintenance and administrative costs. Currently, I see these costs running at $500 to $800 per year, so not extraordinary. Arguably, the tax savings offsets these costs, but it is still something to be aware of. There are strict eligibility requirements to always be aware of as well. Solo Ks are only available if you have no full-time employees other than you and your spouse. If you hire an admin, the Solo K is basically a dead option. Okay, so you're weighing the pros and cons. Now let me give some perspective on why, or maybe when, this type of plan can be a best fit option, like it was for Joe. The Solo K is a best fit retirement plan because it allows for an aggressive retirement saving strategy. It provides numerous tax advantages and also offers investment flexibility. For those who are high income earners with no employees who want to be able to leverage high contribution limits to their advantage, this can be a great solution. Solopreneurs sometimes find themselves looking for a way to create cash flow during lean times. While I never recommend drawing down retirement savings, the Solo K does create a potential tax-free and penalty-free cash flow source with the loan provision. While Joe has never used the loan provision, I work with another couple who flip homes for a living. When caught between the process of the sale of one property and the opportunity to purchase another, this couple was able to take a loan against their Solo K plan, fund the down payment for the purchase of the new property, and then pay off the loan after the sale of the first property closed. Hopefully by now, you know I like to share actionable information. Let's take some action on this. This week, I encourage you to evaluate your current retirement plan and consider whether a solo 401k could be a better fit for your financial goals. If you don't have a retirement plan, then the action you should be taking is evaluating the options available, which I did list again in the previous episode. I want to close by saying that the Solo K is not the right solution for every business owner. Work with a tax professional and financial advisor to figure out whether it could make sense for you and your long-term financial goals. Take the time to consult with professionals to ensure you're making the best choice for your situation. Also, my compliance department noted that I said tax-free a lot, and they'd like me to point out that when you take money from these retirement accounts, it is income. Income may be subject to local, state, and/or the alternative minimum tax. Yes, even tax-free income from a Roth account. Thanks a bunch, Michigan and Mississippi, for figuring out how to assess a tax on a tax-free account. And thank you, listeners, for tuning into this episode of The Financial Flow, brought to you by Tidepool Wealth Strategies. Until next time, stay resilient and plan to retire well. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon, 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.